Okay, in this video we're going to take a look at one of the most important terms to a stock picker. Analysts call it operational gearing, and if you really want to understand how stocks behave, why some stocks are more volatile than others, you need to understand this term. It sounds like a bit of a mouthful, operational gearing, but actually it's a fairly straightforward concept to get your head round, and it's one that will influence your stock selection. Okay, so before we dive straight into operational gearing, a little bit of background about companies. Essentially, a company's profits are a function of the amount it sells minus all of the costs it incurs. So, sales revenue minus costs equals profit. Now, operational gearing deals with costs, and as a firm, you can split your costs into two types. On the one hand, you've got fixed costs, the costs that don't vary with sales. On the other hand, you've got what are called variable costs. These are the ones that do vary with sales. So imagine you're running something like a magazine. Certain costs are fixed. For most organisations, these include property. You can't just leave the building if you don't sell anything. And staff costs. You generally have to pay full-time staff a salary, even if you sell only one magazine as opposed to 5,000. But there are some costs that are variable. Light, heat, gas. You can turn all those things off if the building's not being used. So in that sense, if you're not selling anything, you can reduce your costs. So when you're running a business and you're thinking about your profit, your sales revenue minus all of your costs, it's important to think about how many are fixed, how many are variable. And that's the crucial bit of background that you need for operational gearing, because operational gearing is the relationship between fixed and variable costs. And it's a really important relationship when you're looking at different sectors and looking at specific stocks. And what I'm going to do now is take a look at exactly why. So, imagine I'm looking at a very simple firm that has the following cost structure. So imagine its sales are £100, $100, very simple example, obviously not a real life example, but it sells 100 and costs to get to profit are fixed. Of 80. So imagine that's your property and staff costs, make them negative because they're costs, and you've got your variable costs, that's your light, your heat, your utilities and so on, of 10. Very simple business. So you now have a profit, one minus the other, that's revenue minus costs, of 100 minus 80 minus 10, so that's 10. Great. So far, so what? This is a business with high operational gearing. Fixed costs are a very high proportion of total costs. Total costs are 90, fixed costs are 80, and that has a dramatic impact on what happens next. Because, take this business, and if you're thinking, what kind of business is this? The answer is, this could be a bank, an airline, could be a hotel business, high fixed costs. Imagine sales now rise by just 10% the following year. So we have a good year. Sales go up by 10% to 110. Good news. Here's why this business's high operational gearing matters. Fixed costs are fixed. They don't vary with sales. So those fixed costs, we can assume, stay at 80. Variable costs, these do vary with sales. Printing costs for a magazine, light, heat. The more you make, the more of these you incur. So we could assume if sales go up by 10%, fixed costs will stay fixed, but these things will also increase. If you sell more magazines, you've got to print more magazines. So they will also go up, presumably by around 10% to 11. So a 10% increase in sales, great, all businesses want to achieve increased sales, moves the profit figure to 110 minus those fixed costs minus those variable costs, so that's 110 minus 80 minus 11, that's 19. Now something quite interesting has happened here. This business has increased sales by 10%, but profits from 10 to 19, that is an increase of 90%. So for a very small increase in sales, you get a whopping increase in profits. You might be thinking, fantastic. So this is the kind of firm I want to buy. I want to buy shares in this kind of company. That's tremendous. Yes, except that it works in exactly reverse too. In a downturn, like we're in at the moment, these businesses can be dangerous. Their shares can be highly volatile because of high operational gearing. And that's because had sales dropped by 10%, profits would have been effectively wiped out. And that can happen very quickly. And there's not much they can do about it. Think about banks, think about airlines, think about hotels. These are sectors that have this problem, high operational gearing. In the boom times, it means banks, investment banks, Goldman's, JP Morgan make mega profits, super profits, far more profits than any other type of business because of this, largely. Their two biggest costs are staff, fixed largely, other than bonuses, and property. You can't just sell a property and walk away from it. In a downturn, profits get absolutely hammered and they have to move fast. This type of business has to move quickly or it will go out of business. They have to get these down. And if you're an investment bank, there are only two ways to do that quickly. You fire a lot of people, you move premises, that all takes time, or you lose profits. So operational gearing is really quite straightforward. It's the relationship between fixed and variable costs. If a business has high fixed costs as a proportion of the total, analysts will say this business has high operational gearing. And it matters because sectors with high operational gearing will be much more volatile in profit terms and share price terms than sectors that have lower operational gearing. And that's an important consideration to bear in mind when you're looking for stocks.